Howdy, Jacob here. Today we're looking at Calix. It is in the communications equipment industry, 2.3 billion market cap, just over 2 billion enterprise value. We see very impressive growth, over doubling over the last 10 years with improved gross margins and moving from negative to positive operating margins. Their return on invested capital is low, but again, they're still in the growth stage of just starting to make money and figuring out how they're going to become efficient, whether their margin's going to be. This might be more of a story here, but um, I think it's still reasonable to be able to make assumptions, especially with an R&D spend as high as theirs. You cut that in half, add that to net income after taxes, you're probably looking at 70 million. 7%, really not terrible. We'll see if that sounds reasonable-ish. This type of industry, 50% roughly gross margin. But the story of it might be look at similar companies that maybe are a bit more aged. What can their margins look like? And then we'll see what they have done with the cash that they've made so far. Majority going towards reinvestment, and then a bit to share repurchases. Balance sheet has 220 million cash-like products with no short-term debt, no long-term debt. Very beautiful balance sheet. That's wonderful. No concern there. And then again, good free cash flow, but they have a good amount of stock-based compensation. So it's not that. So they have been buying back shares, but really you're going to have to buy back shares to offset stock-based compensation. Otherwise, they are reinvesting a bit back in themselves. So let's start with some assumptions here. On the revenue growth side, the last 4 years have been absolutely amazing. I may dampen it down quite a bit. Let's try 8%. It's still small. I think that they engage in the provision of cloud and software platform system and services in the US and globally. I feel like there's still a lot of room to grow here. I don't really know exactly what they do, though, so I will be a bit on the conservative end here, or it might not even look conservative to you, but for me, based on the numbers, I feel like this is fairly conservative. And then for margins, this is where I'm going to have to make something up. I'll probably do a slightly large range here, 6 and 10%, with a share change of offsetting stock-based compensation seems pretty reasonable. So, I mean, again, if they're able to grow, keep this revenue growth at this 19 to 27% range for the next 7 years, I mean, while finding a very appropriate margin for them, if it's mid-teens, that could explode this business. But for me right now, I want to lean on the conservative end. I don't understand the business enough based on the numbers and what I've understood about the company to be able to really create a good story. If you think that this might be a great investment and you understand this business, I would definitely do your deeper dive and understand whether you think that they can really get some margin improvement. Because for me, I do feel like I am being conservative here, and that's what I like. I like to be conservative until I need to do a deeper dive on a company. But for now, for me, I'm just going to be waiting until it gets to a more attractive price. Hope you enjoy the video and have a great day. Thank you.